subject of this program, that is financial management. But before I start financial management, you need to know certain things like every organization has to manage its business affair in most effective manner in order to achieve the goals and objectives in efficient manner. Every organization has to like manage the things in order to achieve their objectives and goals. But achieving objectives and goals should not be through one basic rule or principle. In every organization there are a number of specialized activities, or we call specialized departments. Whether it is IT company or pharma company, everywhere you will find production department, marketing department, HR department, finance department, even IT department. And large organizations are also having R&D department. Stand for R&D,
Research and development.
research and development. The task of this department is to bring creativity and innovation in the existing product. Take the example of Samsung. You see how many models the company has introduced, and still demand is there. New and new models are coming in the market. Had Samsung confined itself to Samsung S1 only, then they would have lost the market. So creativity and innovation will lead to further increase in the sales and turnover of the company, and that's why large organizations spending huge amount on R&D in order to bring innovation, productivity, invention, and making products at lesser possible cost with more value to the customers. That is the task of R&D department. Similarly, we have finance department, and the main task of finance department that you need to understand, since you may not have studied finance earlier, and that's why uh, I will discuss finance right from the ABC. So first thing, uh, I'm very sure all of you might be knowing, when I talk about what is finance, what will be your answer if I ask what is finance? See, when we talk about finance or financial management, we are talking about management of financial affair of any corporation. Management of financial affairs of any corporation. If there is any activity related to finance, that will come within the jurisdiction of finance department.
Monetary value of a company is known as finance and its transactions.
Monetary value of the company is known as finance. Okay, any other answer?
So the capital.
Your voice is not clear.
Sir, finance is related to the study and management of all the finances and all the creation of money in a company. Like its investing portfolio, its borrowing, its lending.
Overall capital.
Overall capital.
It can be management of all the inputs and outputs.
Management of all the inputs and output.
So availability of money when it is needed.
See, when we talk about finance, it deals with all kind of sources of fund, whether long term or short term, various provisions of fund, means, methods, and techniques through which it can be raised. So when we talk about finance, it means we are talking about two important aspects. One is finance deals with how to mobilize the fund. Actually, I'm writing with the mouse, and that's why. How to mobilize the fund? See, most of the banks do not have anything of its their own. What they do, they get the public deposit, and they have to pay interest thereon. Banks may issue shares to general public. Banks have to give ownership to them. So, first important task of finance is to mobilize the fund. As and when fund is required, make the provision, make the arrangement of the fund. This is the main task of finance department. Suppose some production activities are going on, some expansion activities are going on, finance will be required. So finance department has to make arrangement. Finance department may not have finance, so to arrange from different sources. So in case of mobilization of fund, what you need to know, what are the various sources of finance. A layman is also knowing from where to get finance. Obviously bank is the option, but being a professional, of finance, you need to understand not only conventional form of sources of finance, but some innovative ways of raising money. Why innovative ways? You have to apply your professional knowledge in minimizing cost. Finance is not free of cost. From whatever source you raise finance, you have to pay certain cost. If you raise money from the bank, you have to pay interest. If you issue shares, then you have to pay dividend. If you issue preference shares, you have to pay fixed dividend. So there are a number of sources of finance. There are a number of international agencies where fund can be raised. There are a number of innovative ways like ADR and GDR through which fund can be raised. Venture capital is another option. Lease financing is another option where fund can be raised. So first thing is you need to have proper knowledge about various sources of finance available worldwide. Nowadays, it is possible to raise money not only from within the country but from abroad, and raising money from international agencies will give you lesser cost. And your effort of raising finance should be to minimize the cost of capital. When a layman is raising money from the market, cost will be different. But if a finance professional is mobilizing the fund from somewhere, then cost of capital should be minimum. And how to calculate cost of capital, that you need to understand. Unless you know how to calculate cost of capital, you cannot decide how much is the cost of your fund. Okay, sources of finance you have to study. Second important thing is cost of capital you have to study. Third thing, which is given in the syllabus, mostly the syllabus of financial management is universal everywhere. Same things have to be studied. Various sources of finance, cost of capital, and then you have to study about leverage. Study about leverages, that is financial leverage and operating leverage. See, leverage will let you know that there is certain benefits to the organization when two different sources of funds are raised. Fund is raised from two different sources. So that thing you will study. Normally, a layman is knowing whenever fund is required may go to a bank and bank will give the entire amount. But from finance point of view, you have to minimize your cost. You have to get maximum benefit, and that's why you will study about the leverages to raise money through equity shares or debt. So broadly, a study of debt equity ratio, how much benefit you are likely to get. So all these things you will study in leverages. And once you have decided that debt equity ratio is important, now next important thing is what should be the composition of debt and what should be the composition of equity. How much fund should be raised in the form of debt and how much fund should be raised in the form of equity. Equity is the own fund and debt is the loan fund. So deciding the composition, proportion or percentage of own fund and loan fund is the subject matter of capital structure. And capital is the amount which is long term in nature. Capital is the amount which is raised to establish the business or to expand business activities or to diversify business activities. So this fund is raised for longer period of time. For example, in order to expand business activities, suppose 100 crores of fund is required. And how this 100 crore will be raised, the task will be given to finance department, and finance department will study leverage benefit or composition, and then finance department will decide how much fund should be in the form of loan and how much fund should be in the form of equity. So it is the subject matter of capital structure. So in case of capital structure, you will study the makeup and composition of capital. Is it clear? I'm just giving the brief introduction about the syllabus. Am I audible?
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
See, once fund is raised, 100 crore or 500 crore, whatever, once fund is raised, the next important task is to make the best use of the fund. So finance deals with two things. One is to mobilize the fund, and next one is to utilize the fund. To utilize the fund. Take the example of bank. Bank is raising money from general public in the form of public deposit. Then bank is not keeping that fund idle. Bank is using that in proper way by giving loans or by making investment, so that whatever commitment they have done to depositors could be fulfilled. Take the example of insurance company. Insurance company is not having anything of its own. Insurance companies normally sell policies to receive the amount of premium. And whatever amount of premium is collected, it is pooled. And the next important task is to make the use of that premium money so that whatever commitment have been done to policyholders could be fulfilled. Like sum assured will be given after a certain period of time, or in case of death or in case of accident, a big sum of amount will be given. All these commitments insurance companies have done to towards the policyholders, and that's why that fund must be utilized. So there is a team which is working for this particular task. Take the example of mutual funds. Have you heard about mutual fund companies?
Yes, sir.
Investment into different shares offering good return as compared to bank deposit or conventional form of investment. But everybody is not having proper knowledge about the stock market. So these mutual fund companies have been established to bridge the gap between those investors who want to earn good return, but due to lack of knowledge about the stock market or lack of knowledge about the mechanism of the stock market, they are not able to do so. So mutual fund companies are formed. They raise money from the general investors, and they have got a very good team comprises of fund managers or investment managers or portfolio managers having vast knowledge and experience investing money into different securities through stock exchanges. And the amount is so large, quite large, that after charging their meager administrative charges, fees, or commission, rest of the amount is written back to investors. So investors are highly benefited. In America and Europe, most of the public saving is in the form of mutual funds. In India, it is in the form of bank deposit. Still, why in bank deposit? If you analyze over a period of time, rate of interest offered by banks are declining. 20 years back, it used to be 12 to 14% fixed deposit on fixed deposit, but nowadays hardly 6 to 7%. But still, most of the investors in India prefer keeping money with the bank. But in time to come, you will see when a rate of interest will decline, then what will be the option? Suppose bank is offering 4% on FD, then there will be option for the investors to go for the mutual funds. So mutual funds are not having anything of its own. They raise money from general investors. They invest money into different securities listed at stock exchanges, and after charging their commission or administrative fee, rest of the amount is returned back to investors. So second important task of finance is to make the use of the fund. Make the use of the fund. So for utilization of the fund, you have to study about capital budgeting, which is given in the syllabus. Have you got the syllabus?
Yes, sir.
Capital budgeting. So capital budgeting deals with making long-term investment decisions. Suppose huge amount has to be invested into some project or into some business venture, which is irreversible in nature. Once investment has been made, then whatever profit and loss you have to bear. But before making or before commitment of fund, you have to make proper analysis. You have to make it foolproof that investment will give you return. So there are a number of techniques which you will study in this topic, that how to analyze, how to estimate the earnings of a project, whether project will be profitable or not. Once it is estimated that project is likely to give profit, then only investment should be made. Okay. So various techniques of capital budgeting you will be studying in this particular topic. And once investment is done, obviously there will be returns, generated returns. In case of companies, what happens? Whatever are the total earnings, entire earnings are not distributed to shareholders. Certain amount is reinvested and certain amount is distributed. So deciding this thing is the subject matter of dividend policy. The subject matter of dividend policy. How much dividend should be given to shareholders and how much amount should be retained? Whatever is the total earning, so a policy has to be made for that earning in regard to distribution of dividend and retention for reinvestment. So this thing you will study in dividend policy. And to manage day to day or routine business, we have to do working capital management. Working capital management. In this, you will study most of the short term fund in case of a manufacturing concern is in the form of inventory. So you have to study inventory management. Then you have to study receivable management. Goods are sold on credit basis. So how to recover amount from them. So you have to study about receivable, and then you have to study about cash, whatever cash is available, how to make the use of that cash. So broadly, if you analyze, finance deals with, if you go through books and literature, finance deals with three important decisions. One is financing decision, second one, financing decision, and utilization means investment decision, and third is dividend decision. So finance basically deals with three important decisions. In case of financing, you need to know about various sources of fund. You need to know about cost of capital. You need to analyze about leverages. You need to study about capital structure. And then when it comes to actual investment or utilization of fund, you have to study about capital budgeting, and you have to know about working capital management. And then in case of dividend decision, you have to study about dividend and retention ratio. How much amount should be distributed and how much amount should be retained. That is the subject matter of dividend policy. See, whatever decision in finance you take, there are certain objectives. How to know that your decision is appropriate, how to know your decision was correct, or your decision was better or best, or what was the nature of your decision. Then it can also be analyzed. Once a best investment decision or best financing decision or best dividend decision is one which leads to achieving three important objectives. We can say that finance decision was best once three objectives are achieved. Objectives are value of the firm. Whatever decision in finance you take, your objective should be your that decision will lead to increasing or improving the value of the firm. Is it clear? Overall value of the firm must go up. Second thing, second important objective is who are the real owner of the company? Who are the real owners of the company? Equity shareholders. Equity shareholders are the real owner of the company. They are taking risk. They are giving fund to the company and they are expecting return. Equity shareholders are not given assured return. They have given money, they have invested money in the company in order to get the profit of the company. There may be possibility of loss is also there. They may get profit, they may get loss, and that's why the best finance decision is one which leads to increase in the return to or return of equity shareholders. Owners must be getting good return. And third thing is whether you take financing decision or dividend decision or capital structure decision, there should be reduction in the cost of capital. There should be reduction in the cost of capital. Cost of capital must go down. So the best financing decision will be one which will lead to maximization in the value of the firm, increasing the return to shareholders, and minimizing the cost of capital. These are the three important objectives that every firm has to achieve. Is it clear up to this? If you have any question, any kind of doubt, see, I'm very sure most of you are from diverse backgrounds, so the kind of terminology we are using in finance may be are different. So if any one of you is not able to understand any particular concept or term, you are free to ask. I know Many of you will face this problem.
Sir, leverages, sir. I don't understand the term leverages.
You have done BTech?
No, sir. BSc IT, sir. Vocational course.
Okay, BSc IT you have done. Leverage means sometimes if you have two sources of finance, you have taken loan as well as you have issued shares. So in leverage, you will study by virtue of taking loan, you will be able to give more return to equity shareholders. Normally, in case of loan, cost is fixed. Company has to pay 8% or 9% or 10% interest. But to equity shareholders, company has to pay depending upon the available profit. Suppose your total earning on your investment is 20%. The fund which you have raised, suppose it was 10 lakh rupees, and in this 10 lakh rupees, 4 lakh was equity. Equity share means ownership fund, and 6 lakh was in the form of debt. So on this 6 lakh, you have to pay fixed rate of interest, suppose 8%. And to equity shareholders, you have not to pay fixed, depending upon the available profit. See, this Zoom class is for 40 minutes, so less than 1 minute is left. So you may rejoin, okay? The moment it completes, it's going to end. So you will rejoin. So total 10 lakh fund was raised by the company, 4 lakh by issue of equity shares, and 6 lakh in the form of loan. And 20% return is expected, return on investment. So total profit will be 2 lakh rupees to the company. So you can see this 2 lakh was generated on all the money, 10 lakh, which was in the form of equity and debt. On debt component, you have to pay only 8%, but profit generated by using 6 lakh was 20%. So this extra 12% profit which was generated